Exactly, because they had all their people on, and I was actually out, and then the Australian, I think Matt Cranston wrote an article, and then Phil Curry, the same day wrote an article.
Yeah, but they got whacked over the knuckles for it.
In the Fin Review, and then I got in, but a number of the other people didn't. But I tried to explain it really simply. So if you got someone on a zero, say a 19-year-old, 20-year-old, working at university or after school, trying to make a little bit of money, and they invest. Say they make a little bit of money and they invest it in a company.
Yeah, showing a bit of get up and go.
Correct.
Yep.
And the company makes some money. Then they own the shares for a year. Mm-hmm. Then they'll have to pay a minimum of 30% tax, even though they might be earning less than $20,000. So they shouldn't, on their income, they pay no tax.
Yes.
So first of all, capital is going to be taxed more. But say that company makes $100. The company that they invest in made the $100, and they pay $30 tax. Yep. And then the other $70 they can pay out to that individual as a fully franked dividend.
Yes.
So that individual gets that $70. Paul Keating got rid of the double taxation.
Yep.
They claim the franking credit, so they get the $100 back. So effectively they're a zero taxpayer and they're going to pay zero tax on that dividend that they got. Say that same company made the $100 and they didn't pay out that $70 in a dividend. They just kept it in the company and the share price went up by $70.
So got a capital gain.
Exactly.
Yep.
So the 30%'s already been paid and they've made the $70 they get, but they've got to pay 30% tax. Mm. So 30% of 70 is 21.
Yep.
So that individual, if they get it as a fully franked dividend and they're a zero taxpayer, they pay no tax. If they get it as capital, they pay 51% tax. The maximum tax rate is 47. That's on a zero taxpayer.
Yeah.
And on a 47% taxpayer, the old system, you're paying 46. On income, you're paying 47. You had to top it up if it was franked. If it was capital, you're paying 46.45%. So your capital gain was slightly less. On the new system, you're paying 62.9% on a capital gain after the company's paid the tax. So they're all significantly higher than 47%. Yeah. So to me, again, it's gaslighting. They haven't done the correct numbers. The why would you invest in capital? Capital gain is a dirty word. As an individual, that young person, they're better off not buying something and owning it for a year and having it as capital. They're better off being a trader.
Yep.
Because if they're a trader and they're a trader for tax purposes and they make the same amount of money, then they don't pay any tax until they get over $20,000.
Yep.
So to me, in terms of the unintended consequences and the change of behaviour, that's just one example. So then individuals, growth becomes a dirty word. Mm-hmm. So you don't want to invest in companies that are going to grow. What you want to invest in companies that are only going to grow by inflation.
Oh, right.
Because then you pay no.
Right.
So if you're going to make 10% per annum, you want to make 3%. You want that 10%. In the old days, you'd want that 10% to be capital growth.
Yep.
Now you want that 10% to be 3% of capital growth and 7% of fully franked income. That's what you want. Mm. So effectively, all the money, if you are going to invest in the stock market, don't invest in growth companies. Don't invest in small Australian growth companies. Don't invest in mining companies. What you've got to invest in is companies, big old companies. Mm-hmm. They're going to pay the big oligopolies or the duopolies that are going to grow at, say, inflation. So you pay no tax on the capital gain and pay you a big fully franked dividend. Who are they? All the money will go from It'll go to
all the blue chips, etc.
Yeah, all the blue chips. Yeah, it'll be the oil and gas, energy, oil and gas companies.
All the mining organisations they don't like anyway.
BHP, Rio, it's the four banks, it's the REITs. That's all the money will go. If you're going to invest in the stock market, invest up there. So how does that help?
Doesn't.
How does that help Australia? How does that help growth in Australia? Like, to me, it's just so basic, as you said, economics 101, and so illogical what they're doing.